Okay, so welcome everybody. This is the Ask a Question from David Shine video now. And this is David with me. I have the questions here, so let's get going and let's find some answers for people from Hungary. Okay, so the first question is from Peter Gergely. And he is wondering whether you have something in a printed form, not in an education seminar or a webinar, but in a printed form to learn winning strategies of trading. Because there might be some people whose schedules do not allow to attend even a webinar, and or maybe they are just better off just looking at stuff and learning things that way.
Right, so that's a good question. Here in Shine's Trading Room, we have a book by one of our lead broadcasters. It's called, it's by Mark Melnick, and that's one of the books that a lot of guys read, and that's towards momentum trading. Also, I produce something called the iBible, the Shine iBible of trading, which has been a list of fundamental rules that I've built over the past 15 years or so in the marketplace, and I live by them, and I've seen people literally copy them down on their hand and use them as a checklist on their screen as they're trading to make sure that they're covering those really important fundamental rules of trading. And that's in addition to our normal education and our seminars and our webinars.
And the iBible is available for free, is that correct?
It's out there. I'm not sure if it's available for free. Like, it's not something that we distribute to people, but it's something that's given with our course, and it's around.
And people can buy Mark's book on your website,
sure.
Right?
You could go to shinestradingroom.com and purchase Mark's book, or you could speak to Peter, of course, always, and he'll help translate the process, I guess.
Okay, cool. Next 6 questions actually from István Horváth. Some of them could be groups, so this is what I'm going to do. So the first question is, how do you decide which stock is going to be your favorite for the day? And also, like, what are the criteria for that decision? What are the criteria to actually trade one stock, or what are the criteria to stop trading a stock during the day? And what are the criteria to focus more on a certain stock?
Okay, I mean, let's take it with that. And István, thank you very much for the question. We're going to have to speed through these as much as we can, since we did get a lot of questions, and there are a lot of more questions I'm sure that will be coming in after this. So the first thing, when I look for a stock, I look for 2 things to be in this stock. I look for liquidity and volatility. That means that there's enough stock for me to get in and out of, and that's the liquidity part, and enough volatility for me to capture the upside of that stock. So for example, if you have a stock that's going to move $1, I want to be able to capture that, as much of that dollar as possible. If the stock is going to move 10 cents for the day, is that enough volatility for us as traders to take advantage of? And I'd say no. So remember those 2 things, and that's just very basic. It's just volatility and liquidity. So enough move in the stock for you to capture, and enough liquidity to make sure that you could pinpoint your entries and your exits. When it comes to literal translation of what do I want to look for in a stock, I prefer, especially when a person starts off to trade, I prefer stocks between $8 and $32 a share. The reason is because they're generally not as extremely volatile potentially as some of the other $600 stocks, and you'll get every new trader wants to trade Apple, wants to trade Google at $700, now over $700, and that's it's sort of like the entry, the earlier training areas, the $8 to $32 a share versus 600. And the reason is because, once again, you could perfect your risk, which is always what we look to do, and then also have potential upside if the stock has enough volatility to the upside or downside in that case. So those are the criteria that I look for in a stock.
Do you have a specific number in terms of volume, for example, or price range in the stock for the day?
Yeah, so a stock should have at least, I'd say, 1 million or 1.5 million average daily volume. ADV sometimes they call it, and it should probably have the ability to move, and I know this may sound crazy, 2 or 3% in the day. And that should give us enough range and enough movement on the stock. Every day we look to identify in the live trading broadcast the names that are potentially good stocks to trade for the day, whether long or short, but they give us names that will have those types of criteria: the volatility, the liquidity, enough movement, and in the price range where we feel comfortable to navigate and trade. In 2008, I made a ton of money trading some of the bank stocks, and they weren't $200 bank stocks. You know, they were bank stocks in the $5, $10, $15, $20 range, and just being able to take enough stock for enough movement and really kill it and knock the cover off the ball. You know, that was some of my areas of strength.
Okay, so then how do you know if a stock is about to break out big time in one direction? What are the signals you are looking for? If you expect a stock to break out like in the next hour or even for the next few days?
Right. It's probably a longer answer, and just to make it a little shorter, I guess, for Istvan, and we do thank you again for the question. I look for a breakout. Something out of the ordinary needs to happen. So potentially more increased volume we just talked about. Once again, let it be a leader, either to the long side, so it'd be up 2% or 3%, or down 2% or 3%. And you could have a breakout in either direction. Also, what we get as individual traders, we have the ability to feel this level 2. We have the ability to feel the marketplace. So for example, a breakout we've just noticed recently in Google. So Google would go up to about 640, back down to 600, 620, back down to 600, 640, and started hanging out in that range and started navigating towards the upper part of the range. What happened? The market broke out a little bit to the upside, and we're looking for this thing to break above its previous highs and continue rallying higher. You have the same thing in Amazon recently. You have the same thing in LinkedIn. A few other names that I look at and I keep an eye on, and you just see them as they sort of gather strength towards their highs of their trading ranges and then break through. But remember, you do need enough volume, and confirmation, I think, is the key. Confirmation is when it breaks out above that range and holds and continues to rally up from there.
It comes from somebody else, Balázs Notnagel, but it's a very related question, so I just ask it right here. So how do you use the market depth data, the level 2 data? What are you looking for? So how do you interpret what's the information?
You know what? Once again, it is a whole another seminar in itself, as these questions really are broader concepts. So
good question, right?
They are very good questions, and you can ask David Shine, how do I use level 2? In 1 second, it's just not going to be there as an answer. I like looking at level 2. Now, for those of you who don't know, there's level 1. Or just breaking it down a little bit, level 1 and level 2. That's how I look at it. Level 1 is usually you get a quote on the inside market. You get the bid and you get the offer. On level 2 data, below that, you get all the bids that are bidding or looking to buy underneath that inside market price, and you get the prices above that inside market also. So you'll see people both bidding and offering outside the inside market. What it allows for you to do, and just an elementary level, what it allows for you to do, allows for you to see where the next level of saturation or buying momentum or selling momentum is by seeing somebody, let's say, through the market, and he's looking to buy, he's on the bid side of the level 2, and he's looking to buy 3,000 shares, but everybody else is only looking to buy 100 shares. You're then saying, oh, this guy's looking to buy 3,000 shares at this level, a few levels down. You sort of know, and you sort of have an inkling that if he stays, and he doesn't cancel his order, then this is potentially a little bit of a hint towards which direction the stock may go from where that bidder is, or underneath the level 2 where that bidder is. And so I look for those saturation points using the level 2. I look at it like a chess game, like a poker game, as we always call about it, and we see these different market maker setups in that level 2 that give us a hint, that give us a little bit of an edge. And I'm a big believer in every little tool out there in the marketplace gives us a little bit of an edge if we can master it. So if we look at the level 2, it gives us a little edge. And I know there were some other questions about different indicators that may give us an edge. Once again, I believe that each one gives us a couple percentage point edges and gives us a little clue towards the final outcome.
Okay. So, and this question is again from István Horváth. So, in the morning when you get to the office, what are the things you're looking at first, second, and third to make your first picks in terms of stocks in the market?
Decisions for the day. First decision would probably be a giant iced coffee. Right after that, I take out the Shine's Trading Room Morning Cheat Sheet, which you can sign up for. That is a complimentary item, or at least for your community to be complimentary. And
I appreciate that.
And I go through a list of different names that I want to look at for the day. And when they fit that criteria that I just spoke about, I take it from there. Now remember, there are a lot of different types of traders out there. So some people are short-term traders, some people are medium-term, longer-term, in between. Sometimes they call them day traders or momentum traders, or even hyper scalpers. You'll hear Mark Melnick talk about that. Then the next level will be a more of a swing trader, or a few days or a few hours or a few days out. And then you may have a longer term trader, either weeks or months or years. So it really depends on your style, I guess. But for me, when I come in, I look what's going to happen that day. I do have a longer term account also, and I take a different perspective on that. But when I look for that day, I go to cheat sheet, I find certain names that fit that price range, I check the volume on it, I start learning my levels. Remember that phrase, I start learning my levels, and I want to get in at the price when it gets to my exact price. I'll also have an idea if the stock is weak or strong for the day, and I'll start identifying which ones I want to go long and which ones I want to go short. Again, it's a much longer idea, much longer strategy of, where and when and how and why do I implement that trade, but that's basically what I look for in the morning.
Okay, good. So this is more like a fundamental type of questions. Are traders in New York worried about the U.S. federal deficit, and what do you think it will lead to? I don't want to translate the whole thing; it's kind of long, but and how do you think this could be managed, or is there going to be like an apocalyptic end to this thing?
It's a good question, and I don't think it has to do with just New York. I think it has to do with the United States, and I think in general, Americans, as probably anywhere around the world, we're resilient people. Us as humanity, we're resilient people. So when the going gets tough, the tough gets going. When it's time to to work harder and to try to achieve and try to overcome, I feel like that's what we've done since 2008 and the financial crisis. We are coming into an election. I do stay out of politics. It allows for me to keep my head sort of clear. The deficit, I think, on a longer term picture, definitely makes us nervous. Last summer, there was a downgrade of U.S. debt, which I think also made a lot of people nervous. But it doesn't really challenge our resilience to overcoming and to overachieving. On a long-term basis, I think it worries people. On a short-term basis, I come in one day, I feel like the market's going to go up, and I'll use my ideas and all the hints that are out there into predicting if the market's going to go up. And also, on certain days I come in and I anticipate the market going lower because of what I see out there. Today you had Apple down probably 3% or so, and that's a reason why the NASDAQ was relatively weak throughout the day. So I look for short-term versus long-term. I think there are a lot of battles right now between the bulls and the bears, and right now, without a doubt, the bulls are winning out.
So you mean as a citizen you're kind of worried about the debt, but as a trader it doesn't affect your work as much?
It doesn't affect, not only that, I look forward to volatility like we had even last summer when there was again the debt crisis here and the European debt crisis.
So maybe if the problem hits the fan, then you might be able to be able to capitalize on it. Right?
Sure, we love volatility. We like being on the cutting edge of breaking news all the time. We like to see what comes out first and then how the market reacts to it. And we learn from our experiences, and that's what the market's all about. It's going through these experiences. What I always say, what makes me better than a lot of other traders is the fact that I have all these experiences, right? I've been there since 1998, and just being in the market for that year, that amount of time continuously has shown me all these ups and downs in the marketplace. And using experiences, when you see that scenario happen again, we look to take advantage of it as traders.
Okay. So this comes from Zoltán Liska, and he's wondering if you have an investment fund where somebody could invest some capital and you guys would be trading that capital, and of course there would be some profit sharing agreement. He might be interested in investing.
It's a good question.
Such a thing. He asked, if you don't have such a thing, then why don't you have it? And also, if you already have this one for a while, then what are the historic performance numbers for it?
It's a good question, and people have asked me throughout. They've always wanted to give me money to trade, and I just have never taken money from anybody to trade with. We look at it in our world. We try to capitalize as much as we can as individuals, and we do it ourselves for ourselves, and that's what makes this sort of industry beautiful. You open your own retail account and you're responsible for the gains and the losses, and that's invigorating, that's exciting for people. So I've just never done that. We've not gotten to that place yet to be able to do that if we wanted to. We just enjoy trading our own accounts on a daily basis. Did I cover most of the question for Zoli?
Yeah, so basically your answer is you don't have such a thing, and you explained why not.
Right.
So that answers it, yes.
I mean, there are a lot of different opportunities for people to invest different places in different funds and so on, and that's really according to each person's own risk tolerance and so on.
Okay, this comes from István, no last name, and he is wondering if there is a source, there is a place where he could go to find out which markets are the most liquid in terms of the foreign exchange market, the CFDs, these contracts for difference, or other capital market instruments. So what are? Oh, actually, this his last name is here. It's Orovets, István Orovets. And so, what are the most liquid, most looked for instruments?
It's a good question, István. I start with please be careful whatever asset class that you're going to be trading. And even some of the things that you mentioned are not my favorite area of expertise, and even my favorite area for people to dabble in. Make sure that whatever markets you're in, you're getting a fair shake, you're getting a fair commission, you're in a regulated, fair environment. That's what makes our stock market so attractive to people, is because it is highly regulated. People make sure that you're getting a fair shake, and I want individuals out there to be educated that way and to understand where you're going to be trading or putting your money into something. So just make sure of that. At the same time, I don't know if too much liquidity of something, like you asked your question in an interesting way on where is the most liquid of markets, and at times I'm not really sure what relevance that has, because if you can, for example, you may get a stock like Microsoft that doesn't move as much, or Cisco that doesn't move as much because there's too much liquidity. So at times you want a certain amount of liquidity. You almost want it to be one-sided liquidity, where it pushes the stock up or it pushes the stock down. Having too much liquidity, remember, that could also take away some of the volatility we talk about. And the volatility is important to have in there. And the volatility will come with not there being 1 billion people on the offer and 1 billion people on the bid. That doesn't help as much, as if you have enough volatility and enough liquidity to push a stock up or down. That's where you as a trader get your advantage. Remember, small risk, bigger reward. So if you're wrong in that trade, even with the volatility, you take your small loss and maximize on the upside with your potential gain in that same name. So the stock does need to move, and sometimes too much liquidity can put a hamper on that.
Okay, thank you. And these questions are from Balázs Notnagel, and I already asked the one about the market depth data. And the other question is, if you, and I'm going to be shorting it a little bit, if you enter a position and it does work out, it starts to go in the right direction, then how do you decide to let it run more because you expect it to turn into a home run, or when do you take your profit at a more modest level?
What's the name?
Balázs.
Balázs. So to answer that question, I look at it like every trade, you have to have the right balance of capturing profit, limiting your downside, but also trying to find that home run. I'm a big believer in having that home run, and this is baseball terminology, which I'd like you to translate into Hungarian, a home run and a triple and a double and another home run, and having bigger wins out there, right? The ones that you hear about are these huge scores that people have. To hit base hits every day is okay, but then some days you're going to strike out, and those will offset each other. But it's the home runs and the triples that really separate those type of trading numbers at the end. You know, your stats at the end. So really, at the end, when you get into a trade and it starts working for you, each level of where the stock goes to, it becomes a new risk reward. So, for example, if you buy a stock and it goes up $1 in your favor, how much of that dollar are you willing to give back versus making another $1? That's the way I look at every trade. So if you're gonna, and I'd sort of keep a formula of, I don't know, maybe about 25% give back. So I'm willing to risk 25 cents out of that $1 that I'm up in order to make another $1. Now guess what? I'm up another $1, I'm up $2. How much am I willing to risk out of that $2 that I'm up in order to make another $1 or $2? Probably, again, around the 25% give back rule. Now, at each level, I look at it and I evaluate. I also need to have the ability to get out of the trade quickly and maybe get back into the trade quickly, which a lot of people forget that you can do. So, for example, if you buy a stock, it goes up $1, it pulls back in, sure, you could take some profits, but are you ready to get back into the stock if you think it's going to continue to go higher? And that's what I look at, and allows for me to let my winners run. One last question is, why would you not hold on forever? You're up $1 and now you're going to hold on forever, because you could give back your whole $1 in order to make another 50 cents. Is that a good risk reward? And you need to ask yourself, what's my risk reward in every scenario, on every tick of the stock, or every candle sometimes we look at on the stock.
Okay, good. So this is the question about the indicators. So how important are calculated indicators like moving averages or MACDs or the relative strength indicator are for your trading? Are they useful, or are they just making trading more complicated?
A little bit of both. I think that a lot of people complicate it for themselves. I think a lot of people add so much onto their screen that they don't even know what they're looking at anymore. I'm on the simple side of things. I like to keep it as simple and clean as possible. I like simple moving averages and not too many of them. And I use each one of these indicators as a couple percentage benefits towards the final outcome again. So if I could add on 1 or 2 or 3 different things into my formula, then it helps me out. Recently I've been looking at, especially when I do a short-term trade, maybe a shorter-term moving average, and I use a 50-day simple moving average, which will give me a little bit of a direction, a little bit of a area of support resistance, a little bit of an area where if the stock's going to break above that level, now does it hold and continue higher? And when it breaks below that level, does it hold below that level? And that level becomes resistance and it continues to follow through to the downside. And I use these to my advantage. As a general rule, I say to people, any indicator where your statistics at the end speak for themselves and it works for you, continue using it. If you use a random item that doesn't work for you, I believe I had a trader who uses an 8 EMA or an 8-day moving, just 8-minute moving average, and he was like, he was just making it very complicated for himself. So I said, well, how's it working for you? And he said, it's not. And so I said, well, probably you shouldn't use it then. If it doesn't work for you, then don't use it. If it does work for you, then use it.
Okay. And another question from Peter Sakali is that if he holds a stock overnight, then there is a danger that there is going to be a gap in the stock by next day morning. And if it gaps up or down or against him too much, it might jump his stop too. So do you have any ideas how to fight against that problem?
I think the question is about overnight positions.
Yes.
One of the ways that I sort of coach myself and coach other people to be able to protect their overnight position is at times you can hedge your position. Sometimes people hedge their position with either something in the same sector. So for example, I don't know, you're long a semiconductor name and you're short a different semiconductor name, hopefully a weaker one. You may be long a stock and short the indice that it's in, or like the NASDAQ or something like that. Another way to handle it is at times we look at the options market, and the options market allows for us, if we're long a stock and we don't want to have the stock gap down against us, sometimes even as just overnight insurance, I'll buy puts against my position, and it protects me to the downside, and it still allows for me to capture that upside. So if the stock gets taken over, I'll lose a little bit on my hedge, on my option hedge, but I'll be able to make the upside in the stock. And those are some simple ways that I look to hedge my position to protect myself on the overnight.
Okay, thank you. That's good.
Thank you.
And next question from, and actually last question from László Kecskeméti, that he once asked me that what is the percentage of people who become successful in trading? The percentage of people who actually try trading or start trading, and I told him that it's about 1 out of 20. What does he need to do to become that one person who can learn how to successfully trade? He says that during his life so far, anything he put his mind to, he was able to succeed. And how is trading different? He read a lot of books about trading psychology. Is that the most important thing, or is it more important to be a good analyzer of the markets? And maybe doing a trading seminar, our seminar in Hungary, for example, is that the solution, or is it just the first step? And what does he need to do to become a successful trader in the next year?
In 12 seconds, I could give you the answer of being a successful trader or not, starting now. I'm going to start with the end of the question first, and I do highly recommend taking a course with you. If you speak English or understand English, take a course with us. As much education as you could get before you go dive into the marketplace is always a good extra healthy advantage to do. Having that overachieving type of confidence in you is also a very good characteristic to have, and it's important to have. I think that a person at times need to be humbled in the way where it's I was the strongest one on my team. I don't know if that's as necessary in the stock market, but being a disciplined person definitely is. Being flexible definitely is. Learning the rules, staying slow, keeping to your max losses, these type of things. That's what separates people. That's what you should show yourself now as you're starting to get into the business, and show yourself and compose yourself early. And it's controlling yourself in so many different aspects that we'll have to talk about in a different time period. I look at this business like it's the best business in the world if you could pull this off. That's why people try trading. I always say that at times a person can open up a restaurant and they'll put in $200,000 at the end of that restaurant. If it doesn't work, they have zero left. They lost $200,000. Here in the stock market, there's so many different options for what people can do and how you could get involved in the stock market, where you could take such a little risk or no risk at all by just sitting on the sidelines and watching and getting a demo account and learning and going through that whole process to educate yourself and to get the experience. And I think that that's what's most important. I can't tell numbers-wise. I've trained thousands of people, thousands of traders. I've had millionaires in different ends of the spectrums, and I have a lot of people who have not succeeded. It usually depends on the individual themselves. I do say that try to get as much education to separate you from everybody else, but it is important also to make sure that your background, your discipline, your self-strength is very important also. So, I think that that's a good place to start. So on that note, I guess if there are no more questions, feel free to I'll respond back to any of these comments once Peter posts them. You're welcome to contact us or contact Peter in our behalf. And I thank you again for your time.
Thank you, David, for answering all these questions.
Thank you, guys. Have a good night.
Okay, bye.